to the David A. Bettis podcast. Today, I've got Dwight Dye in here. He's a tax professional, a tax strategist, and a real estate investor. And today we're going to talk about real estate as it pertains to tax strategy, because a lot of the clients that I work with and a lot of the people that interact with me, they ask for this. They're like, how do I get into real estate? I want to be a real estate investor. And a lot of that comes from them just believing that real estate is a good investment and it probably produces a result, which is probably an asset that has value and then produces cash flow. But most really don't understand the implications as it pertains to tax strategy, which strategy means savings, okay? If we use the words together, strategy, savings. So I hope you get a lot out of this episode, and so let's go up. What's up, Dwight? How are you, man?
I'm doing great. Thanks for having me.
Hey, man, thank you for being here. So we're going to talk some real estate today. So tell me about your real estate journey. I think you're a real estate investor today, and you've been a real estate investor for quite some time. Tell me how you got in that journey.
Well, I guess it was 2010. I bought a foreclosure in Middle Tennessee.
There was a lot of those, by the way.
Yeah, it was awesome opportunity. So I was able to pick up a property really cheap, and my idea was to flip it. And so I went through, did the rehab, and I had a contract, for somebody to buy it, and it ended up falling through. And so it was where I bought it. It was near a major university, so my backup plan was to be able to rent it.
Yep.
And so the semester was getting ready to start, and with that contract falling through, I just decided to rent it real quick.
Okay.
So I found a tenant, and I rented it out for a few years, and then probably about 2 years later there was another foreclosure in the same area, and was able to get it.
Wow.
And kind of the reverse thing happened with that. My idea was to turn that into a rental property as well. Well, I got in doing the rehab, and the rehab turned out so great. I just hated to have renters in there and college kids partying and tearing it up. So I called my agent, asked her to come look at it, see what I could get for it, and she told me what she thought I could get, and it just made more sense to actually flip that one.
How much did you make?
Made close to 30 grand.
Okay. In how many months?
It's about a month and a half.
Oh wow! See that?
Yeah.
That's powerful. 30
Right.
grand in a month and a half. Okay.
Right. So it was really quick, and so then I was sitting on some cash, and the cash buyer started entering the market and taking advantage of the opportunities that still existed. But for me, having to get a mortgage and finance the property, I was getting beaten out by the cash buyer. So that was the end of my investing at that point. I still had the rental property, but I flipped that second house, and so I decided to invest in a tax office.
And that's how you got into tax savings and started thinking about tax structure. That's
Right,
interesting.
right.
So you opened a tax office with that flip money.
Right.
Yeah, you were like, I want to get into this, and I know just because most of you could watch our other podcasts where we talked about this, but you didn't share this with us. Just real quick, you got into the tax industry how?
Well, my dad's always been in the tax business as long as I can remember. Even working out of our house, he had clients, probably about 20 or 30 clients a year would come drop their stuff off.
Interesting.
And that was back when you had to do them on paper and the forms.
Man.
So
it was abacus too, or what?
Yeah. Might as well. But I remember with the calculator and the tape rolling. But that's how he got started, and I watched that. He would actually go to flea markets and set up a table and do tax returns at the flea market while people did their shopping, and come back and he'd have it ready for them.
Wow.
So he started that way. Then he ended up buying, my parents owned a building, and they were renting it to a person that did taxes. Well, that person decided to close, but they had a couple hundred clients, sitting there. So my dad asked him if he could just buy the book of business.
Interesting.
And actually, best I remember, my dad just said, or the guy told him, you can just have them,
Whoa.
So my dad walked into a business that had at least 200 clients, and he started, building it from there. but he also had a full-time job. So when I finished college, I didn't have a job lined up, and I was moving back home, and he said, well, why don't you come manage the tax office for me so I can continue to work my full-time job? And I said, I don't know anything about taxes. And he said, well, I'll teach you how to do the easy ones, and the harder ones are going to drop off.
Wow.
You know, they're going to want me to come do them anyway. So I did that for 2 years, managing his tax office, and I've seen the fruits of my parents' labor, because my mom's a retired school teacher, and she would come over there after school, help out at the office. And then my brother actually works for him as well. So it's definitely a family-run business, and I've seen the lifestyle that is provided for my parents. They do a lot of traveling, and so when the opportunity came along for me to buy a tax office, it was kind of a no-brainer.
Interesting. So yeah, when you got into the tax industry, you definitely, that was part of your wealth strategy. Build a business, support your family, grow, and eventually get back into real estate, I hope.
Correct.
And now today, are you back in the game?
Yeah, about year 2 of the tax business, I ended up selling the rental property. Well, probably year 2 or 3, because I needed the cash. You know, I was starting a new business. There was a lot of off-season expenses, so I actually had to let go of that rental property.
The one that you decided to rent, that you had, and you sold it?
I sold it to get the cash to help with keep the office.
To run a business.
Going. Yeah.
Okay, you're betting
so
on
I
you.
kind of doubled down, I guess, with
You're
the both
betting
properties.
on you. Yeah.
And so that helped me get eventually 3 tax offices.
Okay.
10 years in the industry. So now I've got excess cash that I'm looking to get back into real estate with.
Awesome, man. So let's talk about why you want to be in real estate. So if our viewers are watching, why would they want to be in real estate today?
Well, I don't know if we've got time to go through all the
Let's
benefits.
pick one thing.
It's very tax advantageous, first of all. It's an asset that's tangible.
Meaning like you can feel it.
Yeah, you can look at it. It'll appreciate, typically.
Which means it goes up in value.
Right. So there's so many benefits to real estate.
Do you recommend that everybody who you visit as a client today get into real estate?
No.
Not everyone. Why not?
It's not meant for everyone. Some people don't like the hassles of dealing with tenants. Of course, you can get a property manager, but when you're more hands-off, that kind of turns it into a passive activity. So in order to really reap some of the tax benefits, you need to be more active.
That's true.
In it. So no, I wouldn't recommend it for everybody.
Okay, so I've been in real estate for the last, and I'm actually, it's so funny, but I was similar to you. I bought 2 properties in 11 and 12, and then I didn't do anything until about 17 or 18 again. So I took a huge hiatus because I was investing heavily in business. And over the last few years, we bought a bunch of properties, and a lot of that came from not only wanting to have assets and a wealth plan. It really was, okay, if I could buy this thing and it could give me some cash flow, and I could find a way to benefit myself in a tax situation, this is what I wanted to do. Because I think a lot of our viewers probably are on a trajectory to they're either making good money or they're on that trajectory to make good money. So if they're on a trajectory, I mean, would you say that that's probably the best time to look at real estate?
Oh, for sure.
And that's because why? What would they say? Why would real estate, just because they needed somewhere to put their money?
Well, I think with the real estate, that would definitely help propel them even faster on a wealth strategy. Building wealth.
Is it because I mean, I know this game a lot, so is it because with real estate they can actually save taxes and they can use that money to do something different?
Well, they can, save money on taxes. With the assets, though, they can also refinance and pull that money out tax-free. So that's another benefit.
Borrow against their real estate holdings, right? Because most people think about it as real estate. It's funny, but I remember my parents growing up, and we weren't wealthy at all. I think my mom told me that the house that we lived in growing up, they paid $30,000 for, and it was a beat-up old piece of crap house that they fixed up themselves because I watched them do it. But I remember their goal every day was to pay off their house as fast as possible. And they did pay it off early. Not very much early, I'd say like maybe 5 years early or something. But they were so proud of that, right? Looking back on that, they would pay extra every month, right? I mean, I don't know if I believe in that anymore. I thought that was a good strategy when I was growing up. I thought, man, that's smart. You pay off your debts really quick. Do you think that's a good tax strategy to pay off your debt real quick?
Well, I think it's good. You can leverage debt, to help propel and go faster. So nothing against your parents. They were doing what they thought was right.
Right.
But had they taken that extra money, that they were using to pay down that debt and buy another asset with it, that might have been an option.
Correct. Because to be truthful, now I look at it as, okay, so even though the house they paid for was, let's say, $30,000, when they improved the property, let's say it went up to $50,000. And then every year beyond that, every year it goes up in value, right? Just like real estate, because if our viewers are watching, they know if they own any piece of real estate, not only does it become worth more every year, the taxes go up every year, right? So it's just an assumption that the value is increasing. So I was like, man, now that I look back at that day or that time, the house they could have probably borrowed a lot of money against. They were afraid of doing that, obviously. Everybody gets afraid of doing that. But they could have borrowed money. And they could have gone to the bank and said, hey, this thing's worth 80 now, or 100, or 150, whatever it went to, which it went up to 100 and something. They could have borrowed that money, and then what would they have done with it? And why would they borrow the money, by the way? Because what kind of income is that?
Well, it's tax-free income.
Tax-free income.
Because debt is all tax-free.
So that's, by the way, I talk about that. I've said that on Facebook many times, and people are like, tell me more.
Yeah, and then people are scared to get into debt.
Because Dave Ramsey told them
right,
not to.
Dave Ramsey. And I used to be a line, hook, and sinker Dave Ramsey follower. And, I've just had my eyes opened to a whole different game. And if you can leverage debt and be smart about it, not just go waste it on some car or
Vacation.
Yeah. And buy something that's going to then turn around and cash flow, so you're paying it back. Somebody else is paying it back for you. That's the key.
That is total key. I see that as the problem. So I think debt is bad. I think debt is bad for people who don't have a plan to make more money. I think that's the biggest challenge most people have. I think that if you are a person who's in a fixed income and you're not looking to advance that income in any way, shape, or form, you're just complacent at it, then it is hard to get into debt.
Well, I think debt is wrong if you're going to go buy something that doesn't produce income.
So a liability,
right.
A purse, a watch, a vacation.
Right.
Well, actually, I have people argue with me that a vacation's an asset because you get to spend time with your family.
Yeah, but once you get back from vacation, it's back to reality, and then you've got all this money to have to pay back.
I get it all the time. They're like, but family is an asset. You're investing in assets. I'm like, bro, the bills don't stop when you go on vacation, right? Like you can't freeze your mortgage and your car payment and your credit card payment and your health insurance because you're on vacation. Those still come, and when you get back, you actually have less money.
Right.
So somebody buys and gets into real estate. Let's say somebody has, and this is actually, I would have said if we would have had this conversation a year ago, this would have been a great conversation to say, if somebody has equity in their property, what should they do right now, right? I wouldn't say the same thing anymore, but say somebody's income has changed significantly in the last 12 months. Like say they were making $80,000, this year they're projected to do $200,000, which can happen in a business owner's mind, or in a business owner's life. And they have excess cash. What first, if you're a tax professional, what's the first thing you think about when somebody has got that much of an increase in income?
Well, it may be that their business isn't structured properly to handle that amount of income, because at $80,000, they may have been filed on a Schedule C, and now that their income is higher, they probably want to look into restructuring it, maybe as an S corp. To save money that way through the self-employment taxes.
But they're going to have a larger liability than prior year, correct? Like just guaranteed because of the fact that they have a $200,000 versus $80,000. It's already automatically a higher tax liability, right?
Right.
So instead of them paying that tax liability directly, instead of giving their money to the IRS, maybe they could think about getting into real estate as an investment strategy?
They could.
I mean, only if they intend to make money this way, right? Like,
Right.
I mean, you have to have intentions. By the way, any strategy we talk about doesn't even matter if it's real estate, investment strategy. It has to be with the intentions to make money. You don't
Right.
you don't invest in anything, even if you're getting a tax benefit. You never invest in anything that you don't intend to make money doing.
Yeah, that's a good disclaimer.
Yeah, not even just a disclaimer. It's
It's the way it is.
It's just a fact. Like, you wouldn't want to just say, well, if I could just save money, I'm just going to invest in this. Well, I mean, then that's stupid, right? Like, because you don't know the outcome. You gotta plan to make money in everything you do. So somebody comes in. So tell me about a strategy somebody could do. Give me something just a simple example of something that would benefit somebody right now if they wanted to invest in real estate and it helps them with their taxes.
Well, the main point, or the main tax advantage with real estate is depreciation.
Okay.
And so that basically gives you a paper loss, typically.
A fathom, right? They call it a
Yeah.
fake loss, right?
Yeah. So by the time you buy the property, even if it's cash flowing positively, by the time you write off your mortgage interest, your property taxes, your insurance, if you're paying for the utilities, and take the depreciation, you're going to end up with a loss, most likely. And then depending on that income from your earned income,
Which is your job or your business.
right, you can use that loss to help offset some of that.
Okay. So just so everybody's clear, have you ever been able to? Because this is a hard this is a hard thing to explain. Have you ever been able to explain to somebody what depreciation really is?
I did a video about a month ago, and on a whiteboard I kind of gave an example of not using depreciation versus using depreciation. And I think for me, I'm more of a visual, so I think it was easier to see when you actually look at the numbers and you can see the difference in the savings.
Got it. So depreciation in words, what would you say that it is? I know we said it's kind of like paper loss. Any other words you would describe it as?
Well, basically, the property, say it's a house, it has a useful life. And so the IRS lets you take a small deduction each year over a 27 and a half year period for residential.
So useful life in the IRS's eyes, not in the real reality, if that makes sense, right?
Correct.
Because it doesn't matter when the house is built; it's when you purchased it.
Right, because you could buy a house that was built in
100
1900
years. Yeah.
and still depreciate that over 27 and a half years.
So the IRS gives you something called a depreciable deduction, right? That's what it is.
Right.
And they decide that over the course of whatever they have decided as the rule, right? It's just a rule. It's not like they have, maybe there is a formula to determine the life of a property. I don't know. But in 27 and a half years, mortgages are 30.
Right.
Like, how do you come up with 27 and a half? But you get
not 28.
Yeah, or 26 in a quarter, right? But so what you would do, for an example, just for simple math, let's say the house was $275,000, right? They would take a deduction of what is it? Is that good math?
No.
No, it wouldn't be math, right? Yeah, it would. Oh, no, it would be, it would be not 10,000. Okay, yeah, it was 2,700. 2,750, right?
Yeah.
A year for 27. No, that's not right either. Is it 30? Yeah, it is, right? Man, we're doing
It'd be 10,000. 10,000 a year.
Yeah.
Yeah, over
Messing that
27
up.
and a half years.
So somebody would just take that deduction on their tax return against any income already.
Possibly, depending on how much income they are
Well,
earning.
from the property is what I'm saying. So like if
Right.
they generate, let's say, 20,000 a year in rental income, they would already get the deduction of depreciation automatically on top of that. So it may be already at zero.
Right.
Maybe. I'm not saying it is. It could be, because you could have $100,000 rental income. Then you still have to add things like insurance, taxes, maintenance, repairs. What else could they add?
Mortgage interest,
Or-
property taxes.
Or utilities that are paid by you.
If they've got a property manager, that would count as an expense.
All of those things would bring them down to pretty much zero. So basically what you're
And
saying...
most likely negative.
Yeah, zero or beyond zero. So you're saying basically if somebody bought a piece of real estate, they could actually get tax-free money.
Right. Because even if you can't deduct that loss, the passive loss, you're still with that cash flow getting tax-free money.
Yeah, because nobody, you don't have to pay. You don't have to pay taxes on it. So that's why that's the beauty of real estate, right? I mean, I think most people who think about real estate think about it as the income generator, and they don't see how it could be tax-free the whole time. Like I had an interview with a client the other day, or a potential client, who got on my calendar. We met, and the whole conversation was about how he can save more money on his taxes. And so I'm interviewing him, I'm talking to him about his situation, and he just says, well, I own 70 houses. And I said, okay, cool. What else do you do? He said, I don't do anything else. I said, okay, so you just own real estate and that's it. And he says, yes. And I said, how much did you pay in taxes last year? He said, 0. And I knew he was going to say 0, because if you have no other income and you just have rental income, and because you get depreciation, insurance, taxes, maintenance, his management fees, whatever it is, I knew that every single property was probably reporting 0 income, because they never made money, because based on the IRS rules, they gave them 0. It calculated to 0 or beyond,
right,
every year. So every single rent check that he received was tax-free.
Exactly.
Every single one of them. So he was trying to go past that for some reason. I was like, so why are we talking? And he goes, well, I mean, I'm trying to save more money on tax. I'm like, bro, you're at 0. Like, how much more do you want them to give you money back? Right. And there are strategies for that, by the way. There are strategies to get money back, but he was in an ideal situation, in my opinion. I mean, I think based on what I calculated, not what he told me, I was seeing like he was making about $280,000 a year.
Tax-free.
Tax-free.
Yeah.
Never paid taxes on it. So
right.
He just $280,000. Most people make $280, paid taxes and payroll taxes. So when they look at their paycheck, they're like, "Oh yeah, W2 says $280,000." But if they look at their bank account, it ain't anywhere near that. It's in the hundreds. You know what I mean? So most people think when they make $250,000, they're going to be rich. Not if you pay taxes. You lose all of it, right? I mean, you're losing. If you make over $300,000, you're losing a third of it almost every time.
Right.
And that's shitty, right? Like that's like horrible. So if real estate is the way to go, why don't most people do it?
Well, that guy that you were just talking about, first, that's just so smart to do that. But question for you first: when he goes to sell it, though, what's going to happen?
Oh man, he may have some taxable events. But here's the deal: I would never recommend him to sell. So he actually was smart enough to know that, and so what he's been doing is every time he gets close to a kind of payoff, he goes to the bank and he refinances it. And he takes that because, like you mentioned earlier, debt is tax-free. So he's taking out all the cash from, because it's got enough cash in it, meaning there's enough equity in the property, and he'll take the money and he'll go buy another one. So as long as he never sells, which he shouldn't, because what he could do, I mean, which you know, if he passes away at one day, his kids can inherit it, depending on the value of the portfolio, but when they inherit it, what happens?
Well, the kids will get whatever the basis is at that point, or whatever the value.
The value of the property. So basically, if he bought it for $100, and he passes away in 30 years, and the value is $300, his kids get the value of $300. $300. So they could sell it at $300,000 and not pay any taxes.
Exactly.
I mean, that's killer. I mean, this guy could transition up to $12 million.
And just for the viewers here, there's also another strategy that I don't mind disclosing.
Sure.
It's called a master lease. So somebody that has that many properties, as they get older, you know, he may get tired of fooling with, you know, the repairs, the management of the properties. He can do what's called a master lease and have somebody like you and I, real estate investors, come in, agree to buy that portfolio when he passes away. But in the meantime, instead of him having to manage those properties, we would take it over, the management part, and give him a set, you know, price each month. So he's still receiving income each month.
And it's a lease payment.
Correct.
Right? Because that's, I don't know the strategy as well as you, but it's a lease payment.
Right.
So he's still back to the same thing, 0 tax, right?
Yeah, still 0. And then basically the kids would inherit it. They would sell it to us. And they would pay 0 tax.
Because they took it at the step-up basis.
Right. So we would just be banking on, you know, he would pass away within,
say
he's 80, you know, within a few years.
I feel like it's. I mean,
So
I don't
that's an
know.
option
I don't know.
too.
Maybe if it sounds like a reverse mortgage, like. You know what I mean? Like, we're gonna pay you to live here until you die, and then we're gonna take the property.
Well, that's an option though.
Yeah.
You know, we would receive all that rental income and then just pay him a smaller amount per month, so he's still receiving income.
With the intentions that we will purchase the whole thing right out when they pass.
Right.
That's pretty smart. That's a really wealth strategy. That's a real wealth strategy. So anyway, we're coming to the end of this. I think that there is. I think there's an allure for real estate today. Like, the allure is be a real estate investor because you're gonna be wealthy. So we discussed how you become wealthy, right? We said number one, well, you probably will never pay taxes on the income from real estate. Probably. That doesn't mean you won't, right? There's an opportunity for it to be a further deduction on your return depending on certain circumstances, which, I mean, might as well just say it. The only way that really, the best tax advantage way for you to invest in real estate is if you are, what is it?
A real estate professional?
Correct. That would be it, right?
Right.
So, and by the way, for that term, most people would think realtor right away. Is there another way to be a real estate professional?
Right. You don't have to be a realtor to meet the definition of a real estate professional. There's a couple main criteria. One is you have to participate 750 hours per year.
It's a lot of hours.
It is. So it's hard if you have earned income from another source to meet that 750 hours. Because also the second criteria is you have to participate 51% more than you do your other earned income. So for example, if you work 2,000 hours at your W-2 job or your business, you would actually have to work another 2,001 hours on your real
How's
estate.
that calculated, Dwight?
I guess the number of hours that you work throughout the year in your W-2 job.
Versus how many you work in real estate?
Right.
But real estate, what qualifies as a real estate profession hour, do you know?
Well, you have to be managing the property. So if you were to get a property manager, you're not actively participating. So you have to manage the property. If something breaks, you need to be the one to go fix it. So you're pretty much a hands-on, 24-hour devoted to that property.
Interesting.
And it's per property. There is a way to do a group election. So if you do have multiple properties, you can group those together to where you don't have to get 750 hours per property. So there's some other strategies that get a little more complex.
Interesting. Well, this is all good, man. Well, I think we intrigued the audience enough to say, hey, okay, we should probably be thinking about this. So if you're out there thinking, I want to be in real estate and I just want to be in it for the income advantages, that's good. But you should see the further advantages, which is in real estate. Which is in tax savings, rather. I've been part of this for the last few years, and I think you're starting to see more of that in your business. And so if somebody needed help with this type of strategy, could you help them?
Yeah, more and more we're having people come in with rental properties. That's something, and depending on who you go to, you may be dealing with somebody that's never even owned a rental property themselves. So it's always best to deal with somebody that's been in the game, that's in the game, to help you with something like this.
It's funny, and I'll call out some people real quick because this is interesting that you said that. On social media, I have a kind of a large group of people that I associate with, and in that group there are other people who are in the tax industry like me and you, who are trying to help people do something similar to this. And I hear it all the time, and I'm like, okay, that's cool, but they don't even own real estate. Right? And I understand you want to help people so that you can eventually own real estate. I get it. But it's hard for somebody to teach a strategy that they've never even employed for themselves.
True.
And it's very, very telling. So if you're out there, you're watching this and you're like, well, my tax professional said they could help me do something of this kind of nature, if you will. I mean, I'm not saying don't trust anybody. That's not what I'm saying. I'm just saying, take everything that you do, especially as it relates to taxes. I believe that the reason that you and I are very good at what we do is because we've experienced a lot of the things that we're doing today. We're doing it.
Well, and I think too, both of us initially started it out as a selfish standpoint. We were trying to figure this out for ourselves. And now we're like, well, shoot, this worked for us. We need to help other people.
Heck yeah. When I saw my first $250,000 tax liability, I was like, there's got to be a way around this, right? And that's because I understood taxes, right? But there's a whole new, not new, there's just a whole nother world when you think about taxes. People think about taxes as filing, and then there's planning. There's two different things. And if you learn the planning side, man, life is so different. Like, you make every decision in your life becomes different. It's when you eat, you determine if this is business. It's where you go and shop and vacation, what you buy, how you buy it, how you acquire it, it's a whole new world. Like, you see the world like differently, and everything becomes an investment rather than an expense.
Right.
It's totally weird. Like, every time I go out and people see me spend money on dinner, I'm like, did we talk business? Sure. Okay, cool.
Right.
You know what I mean? Like, I was gonna eat anyways, right? I got a sign that's really badass. This is a deduction right here.
It
You
is,
know,
I like it.
You know, like, this wall's a deduction, right? Everything in this room's a deduction, and I'm like, man, this is cool, because although deductions are not as great as credits, it's still a work towards zero.
Exactly.
So
It is.
we have to think about this. So Dwight, we'll put your contact, but do you want to give any specific information on how somebody can contact you?
Yeah, so the best way to do it is just go to my website. It's dwd.dwightdye.com.
DWD. Okay.
.dwightdye.com.
DYE. Dwight
DYE.
Dye.com. Yeah, check him out. We'll put him in the
I've got
comments.
some more information there, and you can schedule a strategy session with me.
Heck yeah, free strategy session.
That's right.
Yeah. Okay, so they can learn about, you can learn about them, and they can learn about you, and hopefully they decide to do some business with you. Where are you
Exactly.
located, by the way, just so in case anybody wants to come to visit you?
I'm in Murfreesboro, Tennessee. Just outside of Nashville.
Right outside. By the way, if you guys want to go to Nashville, that's a good place to go.
It is. Yeah. A lot of people come there.
All right, guys. So thank you guys for watching this next episode. I hope you took something away. I know I did. Real estate is a big part of any wealth strategy, and in any wealth strategy there's a tax strategy. And so if you didn't take anything away from this, you better go back and rewatch it, because it's something good. So thank you guys for watching, and we'll see you on the next episode.